My name is Miranda Werstiuk. I work for a group called Monetary Metals, a small US-based lender in the precious metals space. Today we're going to be talking about capital and investment in projects for exploration. As we all know, the exploration space has been difficult for the last several years. There's been a significant decrease in funding that has gone into exploration and discovery globally. Projects are just not getting funded to the manner in which they were supposed to be funded, and how they were done 10 to 15 years ago. Decline across all jurisdictions has been seen, and we need to know or find a way to get money back into the system. So these three experts today are going to talk about their experiences and pools of capital and how that can be deployed into the right projects. Okay, so we're going to start with Paul. Maybe what we can do actually before is just a quick intro on who you are and what you do, and what kind of funding you're looking at.
Yeah, hi, thank you very much. Hi, my name's Paul Quirk. I work at Lionhead Capital Partners. We are a investment firm that invests family office capital into the metals and mining space. We have been investing in mining as a firm for the last 7 years, but our family itself has been investing in the mining business for a couple of decades.
All right, Ken?
Hi, Ken Tainton. I'm Exploration Director for Rio Tinto for Africa, Europe, Central Asia. So obviously a little bit different from the rest of the panel. We invest our own funds into a range of projects. We run a very active exploration portfolio worldwide. We deploy around $200 million per annum into that portfolio, and essentially there to generate new development opportunities for the group, or at least options for the group. If we can, something that will be developed within the house. If we don't quite get the returns that we expect, or the size of a project, we will be happy to spin that out to smaller operators to develop and take forward.
Thank you. Willem?
Good afternoon. Willem, Middelkoop, founder of Commodity Discovery Fund. Founded the fund in 2008. Was a private investor in early discoveries in the last bull market. We're very fortunate. We still have inflow of money. I think one of the very few in the resource space. So we still invest in new discoveries. And we're metal agnostic and we're geo agnostic. we don't care if the discovery is made in Western Africa or in the Yukon or in Australia. We follow the truth machine. We follow drill results, and when there's a great new discovery, we jump in with both feet.
Excellent. Yeah, so we're going to start off here because I think with Paul, we're going to talk about what kind of capital is available to explorers. As I said, particularly we've seen in Canada and in Australia, the capital markets are not working. People are having extreme difficulty in going out and raising equity to support their projects. Paul?
Yeah, well, thank you very much, Miranda. You've got three types of capital here talking right now, I guess. So start at that. You've got high net worth family office funding.
Yep.
You have corporates, and you have fund capital driven by retail and institutional funding, LPs. I think the problem that we're having across the capital stack in the exploration space and even in the leading into developer space is that all the traditional sources of funding are becoming more and less and less. And so, places like one-to-one where you'd go and you'd have a huge amount of retail investors, you'd have the traditional banks, you'd have a number of funds. People are just gonna have to get a little bit more intuitive about how they raise capital, because the capital markets in general are pretty dire in the mining space, and there is less and less liquidity in the construction phase, and especially down to exploration. Yeah.
Willem or Ken, do you want to add into that?
Well, I've said this before, but in a way, the markets are broken because the retail investors are almost chased out of the market, and this has more to do with games being played by brokers and insiders, giving themselves cheap shares and options and warrants. And when you're not in a bull market, you know, the retail guy, he's the bag holder, and he can't make money. So this is in a way a self-inflicted wound, and you have worldwide a few thousand of listed exploration companies, all promising they will make a large discovery within 7 or 9 days. and you know, many of these companies are lifestyle companies. You know, I see the CEOs here and worldwide on all these mining exhibitions and conferences, and they're not finding money here, they're just spending money. So the industry is broken.
Yeah, I had a discussion the other day with a colleague out in Vancouver, and they're a small producer in Mexico, and they have been able to take debt, small amounts of debt, to build the operations, but they are generating cash flow. They have cash in the bank, not enough, and they cannot raise money on the markets. And I know I've been to site, it's not a lifestyle company. There is a real struggle in trying to find the capital to do.
But there's also another side. We still do private placements every month.
Yeah.
So there's still money available for great projects and great investments. And I think my neighbors can agree, but there are very few great projects out there.
No, I think you make a valid point there, Willem. We've been very fortunate. We've had very consistent funding from the corporate ever since the GFC, I suppose, post about 2011. We have a policy agreed of a flat exploration budget, so that gives us the ability to invest through the cycles. And in times like this, we're obviously open to looking for new opportunities. We made a couple of significant investments in our global portfolio last year. You can see there's clearly no lack of projects and people, but you need to be highly selective and really find those ones that have the right goods.
Thank you. And Paul, just quickly, you know, in terms of equity, we were talking about how do you avoid that massive trap of dilution along on the J curve?
Well, I think, and having built my own project up from exploration through to development, I think the biggest risk that owners of businesses have is this dilution effect that happens through the J curve from explorer all the way through to developer. And you used to avoid that by having sort of hurdles, and you would re-rate in the market and stuff, and that just doesn't exist now. So what I'm telling a lot of business owners in the exploration space is they have to get quite creative with their capital requirements for the 5 to 10 years before they become a developer. So if you're going to negotiate equity, try and deliver on hurdles and have a pre-agreed deal with your equity partners on the sort of valuations that they will come in at. It's very hard to do when you have binary outcomes driven by exploration. But the other thing is you can get cleverer about leverage finance. Now, I'm not talking about bank debt, but your drillers will work for equity.
Equity, yeah.
There are other people. So it's just as Willem said, this market is so distraught at the moment and so destroyed that business owners have to think of clever ways to get through the J curve to when they are actually financeable by the traditional methods.
Right. Thanks. So, Ken, we're going to now talk to the exploration potential in Africa. What do you see as some of the key hurdles, but what are the jewels that you can see as well?
So look, just from the number of people outside, obviously there's a huge awareness of the fundamental resource endowment of Africa, despite the fact that large parts of this continent are still relatively immature in terms of the extent to which they have been explored, particularly using current day technologies, current day geophysics, geochemistry, and also revised mineralization models. So the potential is there for everyone to see. I think everybody also realizes that having the potential, whilst absolutely essential as a first step, is not sufficient. You need to have all of the other supporting activities in place as well. And particularly the thing we keep coming back to for Africa is you have to have consistency, predictability, transparency of your systems. It's the one hurdle that we come across time and time again. As a major, we are incredibly sensitive to governance issues, to ESG issues, and any project that has a problem in any of those dimensions is simply not going to be able to be touched by certainly a company such as ours. So having that consistency is a key message that we need to continue to deliver to governments. Ultimately, every dollar that gets spent in exploration, be it our dollar or be it an investor's dollar in the junior sector, is a dollar of entirely risk funding. And so if you do not see a pathway to how you can ultimately develop, that project is going to be massively discounted in terms of everybody's views on investment. So trying to deliver that consistent message, transparency, predictability, consistency, I think is the key from my perspective.
Thank you. Willem, as you're assessing projects for investment potential, what do you see as some of the hurdles?
Well, since we invest our own money as of high net worth retail audience, we're less restricted from an ESG political woke perspective. So we just look for the best value, and there are very few countries in Africa we think are off limits.
Okay.
Of course, there are a few which there are some serious risks, but even the average coup you have in the West Africa's once in a while, they don't change a lot for the people active in mining. It's just another warlord you pay your taxes to. But often the production and the exports are not affected. So we like Africa because it's such a well mineralized part of the world.
Right.
And there's so much to be found, and it's still quite underexplored compared to, let's say, Canada. So we like this region, and as said, most of the countries are open for business for us. But before people come up to me after this talk promoting their projects, which always happens, we're very selective because we only select the very best opportunities. So the project should be tier 1 or tier 2, and there's. We've seen it in the company presentations here in this room. There are quite a few companies who have been successful in finding 1 or 2 million ounces, but that's not enough anymore. We won't touch them. We want to see over 3, preferably over 5 million ounces. Okay. And then you only end up with 1, 2, or 3 opportunities.
Opportunities, yeah. Yeah. Paul, do you want to add anything to that?
No, I think the resource, I agree with Willem's comment there, like in exploration, and actually both Willem and Ken's comment, a lot of people get onto an exploration project and there is no path to ultimate exploitation. And Willem touched on scale there. I think that's very important. And then also everything that surrounds the project itself. I really do think that if an explorer is getting to a stage where they think that they can finance a small project, it's becoming harder and harder.
Right. It's about scale and building those resources to a point to attract the capital.
You need to do as much work to open a small mine as for a big mine. Right. So why take the risk?
Right. Willem, so talking about risk, how do you assess risk? Like, what do you look at when you're looking at opportunities from a risk perspective?
Well, we're a bit different because normally they always say in exploration is about management. And I don't care that much about management because if you make a real world-class discovery, the adults will enter the room and they will kick the management out and they will start running the project. If somebody would have plugged you an investment in Voisey's Bay, a mother company in what was it, 96, and it was run by Robert Friedland, we all would have ran away because Robert Friedland had a very bad name in these days. But once you make a world-class discovery, all problems
seem to disappear.
Yeah, seem to disappear because we focus on the quality of the drill results, and that's and if you focus on the real quality projects, most of the other risks, are very manageable.
Right, you can manage the risk. Yeah, Ken.
Look, we start with going back to the fundamentals of the underlying resource potential has to be there. So technical considerations always have to be that first level of filter on the risk. As I said earlier, I think as a major operating across multiple jurisdictions and listing jurisdictions, we have to put a different filter on other factors. Safety, security of our people is always paramount. So, we run a multi-dimensional risk analysis before we will enter into a country, before we will start own exploration, or in fact, whether we'll consider investment into a junior who's operating in a different jurisdiction. So it's technical, it's then safety, security, and then it's all of the governance factors, governance and ESG.
ESG, yep.
That's why companies like we can make money, because the majors, they prefer to take out a company for 1.5 billion instead for 150 million, because first it needs to be de-risked, and we're always happy to sell it once it's 1.5 billion.
So that's why as a company we run at both levels. So we do the exploration, which is exactly what you're saying, try to find the right project and get a position in the project early, and then obviously we run a corporate merger and acquisition team as well. So they will be doing the ones that you want.
And actually, that's a good segue, talking about, how do you assess risks? And Paul, as I'll ask everybody this, but as an investor, what are you looking for in those companies? I think we've already touched on some of these pieces, but is management, understanding the technical, which is key, as Willem said. You follow the drill results. What else is there that you look for specifically?
No, everyone here has spoken about the key factors. I think what's very important is a pathway to success. So people having a clear definition of what their pathway, and that involves financeability, all the governance around the business, as well as the ore body. The ore body is quite binary. It's you may have indications of a world-class tier 1 ore body, but it may or may not, and that's just bad luck. But what's really important to me is when management's already thinking about network, thinking about what's the commerciality of this, if it's bulk, how are you going to get it to port? That thought process has to happen early on, in my view. I think 1 in 1,000 exploration companies become developers. That thought process has to happen early. Otherwise, you can discover the best, polymetallic discovery, but it's in the worst jurisdiction, or all assets of the logistics, the metallurgy, the processing, and the mining have to be thought, and the governance have to be thought at in early stage. When I see a company that's thinking about all those things, I'm more interested.
Right. Yeah, that's a very good point. And also, I think you spoke to milestones or steps that you can actually see, and the company will achieve those, and then it's further de-risking the opportunity as you evolve, the project evolves and the company evolves.
Yeah. The other thing I find is that exploration budgets can something that always terrifies investors, because they always are quite wide and they expand and etc. But I think it is possible for, unless the ore body expands, which is a good problem to have, to set certain hurdles and budget hurdles and stuff, and then say, look, once we give you this initial capital, then you'll only come back to us if certain things have been achieved, and then we'll deliver more capital after that. I think people should have that more in mind, that there is just not this finite investment coming from people like us.
Right. And I've seen it in my past life as a banker, that many companies get on that treadmill of just going out doing, as Willem said, private placement after private placement after private placement, and just raising small amounts of capital to fuel the machine, but not do anything to advance the machine.
No, if we are contacted by brokers for private placements up, let's say 3-4 million, we don't take it serious, because they will need to come to market in another 12 months.
Yep.
And so there's always this overhang. So, and there's a big difference in Australia. If you have a strong story in Australia, a discovery story, you see private placements which are 20, 30, 50, 60 million right away.
Yep.
And we always like that, because then it shows to the market that this is a serious discovery and serious investors are entering the game. And you don't have this overhang that there will be another financing within 12 to 18 months. And in Canada, most of the brokers, they just want to have the yearly commissions. So we prefer the Australian way.
Okay, thank you. All right.
But the only problem in Australia, they all have a few billion shares outstanding. They should solve that.
Yeah. So I'm going to start with Ken here. So we've seen, as we all know, junior companies have reduced exploration budgets because capital's not available. Even some majors, their budgets have decreased. I don't know if Rio Tinto can say to the otherwise, but how does that impact national and local perspectives, where there's limited exploration funds flowing into a particular jurisdiction? What is the ripple effect locally, countrywide, and across the continent, really?
Look, obviously, it's a really challenging time, as you said. I think across particularly the so-called critical materials and the battery materials space, there's been the surge of investment over the last couple of years, and heat's come out of the commodity markets, and now suddenly you're seeing a lot more strain in that space, and that is impacting across a lot of new juniors started up aspirational projects across the continent, and are going to struggle. It's definitely going to be a major turnover in the next while. What we're seeing, a lot of talk about how regional supply chains are intended to be pulled together. A lot of supportive words from governments around how they're going to support future production that will meet material demands, particularly in the Western world. To be frank, probably not seeing an awful lot of that delivering as yet, and there's still a long way to go to pull together the whole ecosystem that's going to deliver that. And how that's going to work together with national government objectives. So it's a tough period. I think we're going to see a lot of ups and downs over the next few years as this whole market matures, as the exploration industry gets to understand how to play within what is a different space, much more geopolitically driven than pure commodity pricing and project valuation. So I think it's going to be interesting to watch.
Willem?
Yeah, well, all the doom and gloom we hear, also on this panel, it has every cloud has a silver lining, because we'll see massive shortages in all of these metals, and we've seen a huge rally developing in uranium already because of the supply and demand situation. And if you study all these different metals, the supply and demand, the fundamentals, after 25, there are many shortages starting to occur. Copper is a real problem now with the closing down of the Panama copper mine. We went to a production deficit and could see real copper shortages in 25. And this means that prices for many of these metals will need to go up quite aggressively, and that will solve many of the problems, because then we enter a new bull market, and then everybody can be happy again.
Paul, do you want to add to that? Anything?
No, I agree actually on the supply-demand argument there as well. I do think that until, as Ken was saying, until governments start really feeling the pain of that supply-demand deficit, will they actually start spending the capital? Because you do speak to sources of government funding, you hear about companies speaking to sources of government funding, but which are very interested, but they're not actually taking any decisive steps forward in providing capital to these companies until the metals are not available to build their infrastructure or to build out their EV focus and mandate from up top. They won't start spending the money. When they do, I think things will get very interesting.
A great example is Mercedes-Benz, the car manufacturer from Germany, is here with a team of 6 people talking to battery metal.
Yeah, they're going direct to the source. Yeah, right to the source.
But they're asking, they don't understand the business because they don't understand you can't bring 6 people to the table here because there's no table and not enough seats. And then they ask the first question. I spoke to a few of those companies. The first question is, when can you deliver the metal?
Yeah, exactly.
Yeah. In 8 to 10 years. And then, they're German, so they don't show they're shocked. But once they go back to Germany, all hell will break loose in the boardroom because we have this Raw Material Act also in Brussels, and everything is in laws now, written in laws, but there's no funding. And you have the IRA in the US, and then they give grants of 10, 20 million to Talon Metals or whatever, but nobody's putting up the billions to develop the projects. So this is one big shit show.
Well, there's a big disconnect, right? The understanding and that question comes to me all the time. Like, look, we're looking for metal. Can you deliver it next week? And
but it's a tragedy because we laugh about this, but this is we're in this energy transition in which we all need to change our way of living and driving and energy use, but there are not enough materials around to be able to make this transition.
Right, and you need funding on day one. Right, you can't just drop in on day one and say we need the metal. We need the metal tomorrow.
And our politicians never cared about that part.
Right, they just want access to the metal. Yeah. Ken, do you have anything to add?
Well, they can print money to solve all problems, but you can't print commodities. That's the problem.
You can't print cobalt or lithium or copper or nickel. Yeah. No, that's very true, and that's an interesting segue into the next question here. So, for example, the U.S. has pushed, is coming to Africa to source, and other countries source critical metals, but there's that gap or disconnect on the understanding of how these projects need to get funded and evolve and develop, and there's a 10-year timeline at a minimum. So I think we've sort of discussed that, and operating in the political reality too. So maybe, Paul, you want to comment on that? Like other countries coming here and trying to navigate the geopolitical reality of countries in Africa.
I mean, I think Ken's probably better placed to do this because he writes the types of checks that they're looking for. But I mean, I do think that the part of the stigma that we're faced with in both the metals industry and in Africa, to answer your question, is that institutional capital and government capital, it's very hard to invest with that headwind of this kind of, it's mining, it's Africa,
right?
The unknown, this unknown sort of grey area. But if they don't, none of these projects are going to come to fruition. Right. So it is, and we'd much. I mean, Africa. I'm an African, and we would much rather have, real institutional and proper state capital coming into the continent than other sources of funding for that infrastructure.
Right. Ken?
As Rio, we've invested in a number of very significant new project developments in Africa. QMM probably going back 15 odd years, where we were part of a consortium that invested into the construction of port facilities to support that operation, and continue to invest into local infrastructure, road upgrades, etc., to link Port-de-Vaux to Antananarivo. Those are very significant cost drivers onto the projects. The by far and away the biggest infrastructure project running in Africa at the moment is the Simandu iron ore mine infrastructure. So 670 kilometers of rail, deep water port. And that's taken decades to pull together an investable framework. It does include Chinese investment, it includes ourselves, it includes investment from the government. It's multiple entities running infrastructure, port, and the mines themselves. And so these are extraordinarily complex organizations and businesses to pull together. Insofar as governments, the US, the Strategic Minerals Partnership partners can come together and act as a facilitator for that infrastructure, that will certainly open up parts of Africa for further development. So very encouraging to see the work that is going on, for instance, in the Lobito corridor, pulling together, again, port rail, and that needs to continue to spread out and link up the existing infrastructure in Central Africa and the DRC and Zambia to get to a greenfields port development site. So there is certainly opportunity, and governments can play an important role as facilitators and coordinators of that. But as you say, they probably at some point are also going to have to come in with the checkbook to help, because there are very few individual mining projects that are of the scale of a Simandu that can justify a developer putting in that amount of infrastructure capital for a single project.
Right. And that's a good point. And we've talked a little bit about the whole, it's not just identifying a project and funding exploration. There's the whole ecosystem around building a project, right? So logistics, supply chain, infrastructure, access to ports, rail, export. How do you export your commodity? What does that look like? So, I mean, there are much bigger realities. Rather, you find the deposit, great, we found a project and we're going to move it forward, but you're thinking about the actual reality of putting a project, moving it from exploration to development, and then into production. I think, Paul, 1 in 1,000 projects cross that line. I mean, that's a very, very low ratio. So, Willem, do you have anything to add to that?
Well, I would like to touch on another important topic, and that's you see competitive tension now from a geopolitical point of view. So you have the West against, not the East, it's the West against the rest of the world. We have 140 countries, over 140 countries who are not following Western sanctions against Russia. We've seen the BRICS alliance doubling in size, and we've seen the Saudis pivoting from West to East. We shouldn't forget that the Saudis were partners of the US since 1974 in the petrodollar deal, in which the Saudis promised oil would always be sold in dollars. And now the Saudis are selling their oil to China in yuan. And this has huge repercussions, because why is Mercedes-Benz here with a team of 6? Because Mercedes-Benz is in the West, and they don't want to rely on China. They could rely on China delivering the battery metals, but there's a political decision to no longer willing to be dependent on China. So now the West is trying to develop their own, mining industry and refining industry. But China is so far ahead. 90% of all the materials for the battery metals come from China. And the West might be able to bring that down to 80 or 70 or 60%, but that's all. Yeah. We will never, but in the West, we can't accept that we lost this war. And actually, China doesn't want a war. China wants to trade with all of us. Yep. But it's the choice from the West to point to China. They're the enemy now. And this is a problem from a geopolitical point of view, but for investors like us, this is like a gift from heaven, because you have competitive tension now. They will fight for the best projects.
Yeah, that's a very good point. And the West is trying to play catch up to
it will help to grow an even stronger bull market.
Yeah. Thank you. So the last question here is, and I think we've touched a little bit of it on ESG and how that impacts your investment thesis and your review of projects. I know, Willem, you said you are commodity agnostic, geography agnostic, and
We're not ESG agnostic, but we don't follow ESG rules
Yes, right.
because we need to do that from
Yeah, no, I wouldn't
because
say-
of our politicians.
Right,
But we always want to pay our fair share of taxes, and we always want to have our fair share of good causes in the country the projects are building.
Right, and I think it's an integral part of the Rio Tinto process.
It is. I mean, we're obviously founding members and co-signatories of most of the large multilateral agreements on governance standards and environmental standards in mining. So it is central to our corporate strategy to make sure that we do adopt global leading practice across all of the ESG dimensions. It's also the right thing to do, and it de-risks the project. Yeah. If you look at the history of particularly large-scale project developments, far more of the delays are due to social and environmental factors than they are due to technical factors when it comes down to actually shovels hitting the ground. So making sure that the work is done to the right standard from day one, as Paul alluded to, making sure that you cover off on all of those ancillary aspects of the project, such as what are you going to do with your waste? What is your waste going to look like? Do you have all of your environmental controls, your ESIAs signed up and agreed well in advance of actually starting to fund development? Those are fundamental de-risking elements. So it is central to everything we do. It's critical, we believe, to delivering value on the projects that we invest in.
Yeah. Thank you. Paul, is there anything you want to add to the...
No, I agree. Like, it's got to start from the beginning.
Yeah.
Social license to operate is so critical in a project that can get taken away. It often gets, it creates hurdles at the end because it wasn't started at the beginning. So, as Ken said, it's got to be thought about right at the start of the project.
Right.
But because of the whole ESG movement, this is going so way out of proportion. Cobre Panama, which was responsible for 1.5% of total world copper production, has been closed by the government after 10 billion was invested, and that's 4% of the GDP of Panama, and nobody's being helped by closing that mine. Well, the copper price and copper investors are being helped because the copper price will jump. So we're shooting ourselves in our foot again, also with ESG, and because of all this, we'll have this wonderful bull market for decades to come.
Thank you. We have a couple of minutes left. I just want the panelists to give sort of a quick summary soundbite on what they're looking at, what they see. We'll start with you, Willem.
A bull market for decades to come.
Okay. Ken?
And we remain very opportunistic investors. We continue to push our own programs and then look for good projects to invest in. We do see huge opportunities across particularly the sort of energy transition metals. So we're looking forward to some good times.
Yeah. Paul?
I guess my comment right now would be that there are good, as we have been quite negative, there are good projects, and they're probably going to be the best pricing in the next year or two to get into those projects than you'll see for a very long time. So if people are selective, there are good projects that they'll never be able to pay the same price again for a long time, I think.
Yeah. Thank you. We do have a couple minutes left. If there are any questions for the panel? Yeah.
Oh, Ken, I just wanted to ask you really, I mean, for Rio Tinto, which obviously is a huge company, I mean, do you, in your role, get set very explicit focuses, for I mean, you're not going to back a project on the back of economics, are you? Presumably it's going to be mainly because you need a particular type of metal, or am I wrong? I mean, do you want to build up your copper presence, or do you want to build up your rare earths or whatever,
So we are driven in part by a high-level direction, corporate strategy, and that very clearly is that we see huge potential in energy transition metals, and of those, when I say that, we have to remember copper and aluminium are first and foremost amongst those. So yeah, we definitely have a lot of appetite for copper in particular. But our exploration business has had a history of breaking with convention. So we do maintain an opportunistic bias. We are prepared to look at commodities that aren't in our current corporate portfolio. And then it does become a case of demonstrating a pathway to a value addition for the company. So yeah, it's a mixed message. There's a corporate direction, but we are not blind to other opportunities that lie outside of that relatively narrow focus.
Thank you. Any other questions? Thank you.
If I can add one,
Yes, absolutely.
because I was very short in my last answer. But when we publish research and give presentations, we like to title it now, "Is the perfect storm developing for commodities?" Because I think you have four main drivers. One is the debasement of currencies. So more and more investors are fleeing towards hard assets. They want to get rid of paper assets. Then you have this geopolitical tension, the East against the West. I think we also entered a new era of higher interest rates, higher inflation. We just broke out a downtrend of 40 years since 1980 of lower interest rates. So that's a major force which will help the commodity bull market to develop. And then the fourth major driver is the fundamental shortages developing.
Right.
And this is, I can't emphasize that enough. That's for the first time since we humans have started mining that we're entering a period where we will see real and continuing and growing shortages. And that's, I've never read any piece of research from somebody who could give advice how to solve that problem.
Thank you. Thank you. Thank you all for your participation and your wisdom and insight and commentary today.